Hello, everyone. This is Alexander Horat with the Free American Press. Today, we're having a very special guest on the show. His name is Andy Schectman. He is the president of Miles Franklin. Hello, Andy. Thank you for being on the show.
Alex, it's good to be back with you. I'm glad to hear we're going to be doing this more frequently. And it's Friday. It's a long weekend. All is good. It's good to see you. And thanks for having me back.
Yeah, that's great. Thanks for coming on. So can you tell the viewers what your gold and silver forecast is going to be for the next 3 months? Will gold and silver continue with their upward trend?
Yeah, I'm going to answer that question in a little bit of a roundabout answer. Remember the last time we talked about the Basel III implementation of gold as a tier 1 reserve asset. Now that was a very, very big deal, maybe the biggest deal of my career. This happened in April of 2019. And just to set the stage to answer your question in a very long-winded way, if we go back to 2017, we saw the German Bundesbank request all of their gold back. And this was an unusual request back from the New York Federal Reserve. And this was an unusual request, Alex, because at this point in time, the central banks are all net sellers of gold. And really, gold was languishing in the face of a racing Bitcoin market. And you had even an equity market, a stock market in 2017 that was doing very good. So gold was languishing, the central banks were net sellers, and out of nowhere, we saw the German Bundesbank say, give us our gold back from the New York Fed, declaring that they wanted it all sent home to them by 2020. Shortly thereafter, we saw the Bank of Austria, the Bank of Hungary, the Bank of Turkey, the Bank of Poland, the Dutch National Bank. All of these banks said the same thing, give us our gold back. They said the same thing to the Bank of England. We want to repatriate all our metals. We want to have possession of it. But it was unusual because, you know, for the better part of almost 80 years, the New York Fed and the United States has held gold on behalf of the rest of the countries. And never was it an issue to have it sent back until it became an issue in 2017. In 2018, the central banks went from net sellers of gold to buying more gold as a group than they did in the 60 years previously completely combined. Wow. Which again, here we're starting to really get unusual. In 2019, the central banks popped that number up by 100%. So now they're really ramping up acquisition of gold. And then the Bank of International Settlements in Basel, Switzerland, which is considered the central banker's central bank, Alex, they said gold is now a tier 1 reserve asset, right there with dollars, levied to a status as good as cash, riskless. And it was the only other asset really on that table. So you had gold and US dollars as tier 1, which is the ultimate form of collateral. Now, it's interesting to note that the central banks would have repatriated all of their gold and then went on a massive buying spree nearly 2 years before the implementation, or actually just the declaration that, hey, we've revalued gold and put it up on a tier 1 status. 2020 rolls along and we see the IMF, the International Monetary Fund, which is 250 or so countries around the world that was formulated at Bretton Woods, come out and publicly say, we want a new Bretton Woods. So you have now all the countries around the world saying, we don't like the standard, the dollar standard, we want a new standard. And then we saw something that has been really a focus of mine for the last year and a half, and that is what has been happening on COMEX. On the COMEX market, when contracts are issued in precious metals, typically only 1 or 2% of those contracts ever stand for delivery. But in 2020, we saw the rise of a third group of reportables on the Commitment of Traders report. Normally, the only two that are ever reported are the commercials, which are JP and Goldman and Citi, and the specs, which are the hedge funds. And one goes long and the other goes short and vice versa. But in 2020, there's a new group that's on the COMEX, Commitment of Traders report, and they're titled the Others. The others are believed to be sovereign wealth funds and family offices. You have the most sophisticated, well-funded private investors in the world who all of a sudden start draining COMEX of metal. In the case of silver in 2020, 350 million ounces or thereabouts were delivered off of COMEX. That's almost a decade worth of deliveries. It's really, really, really basically unheard of. And here we are in 2021, and we're seeing the exact same thing. Well north of 110 million ounces have already been taken off of COMEX this year in the first two delivery months of March and of May. And we're seeing tremendous amounts of gold come off the COMEX market as well in deliveries. And now we're actually seeing tremendous amounts of metal, north of 55 million ounces, actually leave the facilities. They were delivered to strong hands on COMEX, but now they're actually leaving. And I'm wondering, is that Tesla, is that Panasonic, is that Samsung or Apple? Are they securing silver in what the US Mint today, in a publication that they just sent out, explaining why premiums are so high and product is in such short supply? They openly admitted a global shortage of silver coming from the US Mint today. It's all over the place right now. People are talking about it. So you have the most sophisticated private and the most sophisticated institutional investors on the planet, the central banks, commercial banks, the sovereign wealth funds, family offices. They're all doing the same thing and have been for 4 years, copiously accumulating gold and removing counterparty risk, taking possession of it. If we fast forward to where we are today, we see the continuance of the deliveries off of COMEX, as I mentioned. But we also now see the implementation next month of the reserve ratio requirements of Basel III. The Basel III reserve ratio requirements, all of the Basel III declarations were really put into place in 2008. That's when it was established. But because of market conditions and the banks not being able to implement these rules, they've been pushed out and pushed out and pushed out. But it looks like the 12th hour is here as it pertains to unallocated gold accounts. You see, it's the fractional reserve method of trading unallocated precious metals that has been, Alex, the primary means by which the US government and I guess maybe the trading partners of the Federal Reserve Bank, with allied central banks, what have you, have been able to suppress gold and silver prices. They do it through the fractional reserve setup of the London Metals Exchange. And by selling paper contracts without having to actually deliver the physical metals, there is an appearance to those out there looking that there's more metal out there than it really truly is available. And the result are prices are lower than if buyers and sellers of precious metals were actually able to initiate real price discovery based on the supply and the demand. Because on one hand, we have the United States Mint saying there's a global shortage of silver. We have record demand on the physical side. We have record demand out of ETFs. We have record number of deliveries off of COMEX. The big money is, no question about it, accumulating large amounts of gold and silver. In fact, if we look at the April and March deliveries of gold, as an example, out of Switzerland, the refining hub of the world, we look at a place like China and India. Now, here you have two of the biggest gold and silver accumulators in the world. Let's just talk about gold for a second. In the month of March, China took what they usually take, typically about 10 tons of gold were delivered to China. And just to China, and 31 tons to Hong Kong. In April, we saw 40 tons delivered to China, 10 tons to Hong Kong. You're talking massive amounts, massive amounts, 56 tons in April delivered to China. So you have, and when you look at India, the numbers are even bigger. And so in India, over 82 tons were delivered in March, 56 tons in April. So you have, if you realize that they say the United States has 8,000 tons, or right around 8,200 tons of metric tons of gold, and that's supposedly the largest position in the world, I would argue that China probably has 2 or 3 times that. They just don't update their numbers. They've been taking possession of over 10 tons of gold a month, it seems, for as long as I can remember. And here we are, they're ramping them up to over 50 tons in April. So you're seeing massive money accumulate gold and silver. The central banks, China, India, the Western central banks, all of the European central banks save the US and Canada, they're not, but the rest of the European banks really are accumulating a whole bunch of metal. But that fractional reserve system that has enabled them to control the price, like for example, June 2nd, June 1st and 2nd, when the price of, February 1st and 2nd, when the price of silver was exploding right in the middle of the silver squeeze, you had record inflows over 100, what was it, about 110 million ounces delivered onto SLV over that weekend. Record amounts of demand, pushing the price up to 30 bucks an ounce. We were working 24 hours a day that entire weekend, literally all day, all night, just to keep up. In fact, all of the major companies, ourselves included, shut down that weekend because the demand was so big and none of us had hedged properly for what we saw coming. In fact, typically what happens at the end of business on Friday, we will hedge our position into the weekend, trying to figure out if we have enough for the weekend for whatever's coming. Oftentimes my head trader will say, do you have any interviews planned over the weekend so I can hedge our exposure over the weekend? Well, we hedged 11 futures contracts that weekend. That's 55,000 ounces. And by Saturday morning, my head trader called me and said, do you realize that last night we sold 90,000 ounces of silver worth 35,000 ounces naked exposed to the open Sunday night? And by the way, all the online companies closed last night, and I know it's for the same reason. I said, for the first time in 31 years, shut it down. And we did that. We took no business from Saturday morning until Sunday when the market opened. When the market opened, everyone was expecting it to gap up tremendously. It gapped up $2. It cost us somewhere north of 40-some thousand dollars. We were able to hedge it right away. $45,000 it cost us because we weren't hedged. So the next evening, as it is leaving London into New York, someone dumped 1.5 billion ounces of paper silver, which is all a scam because it's not real. That's 2 years worth of global mine supply, $45 billion worth, onto the market in the access market. When London closes right before New York opens, this is the thinnest session, the thinnest trading session you could ever try to do a big trade in. And really no one ever would who was trying to get the best price for what they were selling. In fact, a typical trader who did something like that would be fired, prosecuted, and probably shot for doing that. And so this is how it works. They can take tremendous amounts of paper silver and dump it onto the marketplace, drive the paper price down, and create an effect. And when that happened over the ensuing 2 weeks, the commercial banks actually pulled out 90 million ounces of silver out of SLV. After they put in 110 million ounces and drove the price up to 30 bucks, they knock it down with unallocated futures contracts and then pull out at a $4 discount north of 90 million ounces of silver. This fractional reserve system that allows the big banks to push the price around is coming to an end, in my opinion. On June 28th of this year, the Basel III reserve requirement ratio goes into effect, where the banks will be required to hold reserves against their assets. And the main takeaway is that they will not be able to count unallocated gold against their allocated positions. So in other words, it will be counted at 85% instead of 100 as it used to be on their balance sheet, but it cannot be applied at all against their allocated positions. So what it basically means is that in order for the banks to be able to push the price around, they're going to need to either raise a tremendous amount of capital or just back out of the market and walk away from it, because they're going to need to have 85% collateral behind these positions, because unallocated positions will count zero against allocated positions. They will not be able to push the price around the way that they once did. In fact, I think it's a massive development, because it will just become uneconomical for banks to have that big of a position behind what used to be, the London Metals Exchange trades at 100-to-1 leverage. So it's a rehypothecated market. If you have to have $85 million in equity behind a $100 million short position, you're going to think twice about doing these things. And I think a lot of the big players will just say, screw it, I'm out. So I guess what I'm getting at is this. I expect great volatility between now and the end of the month, as a lot of these banks are trying to eradicate themselves from these unallocated synthetic short positions. And you can see that at night. Typically what I've been noticing is that a market is down in the middle of the evening in Asia and London. And as it heads towards New York and gets to New York, it pops higher. So what you're seeing is selling in the thinner market where the price drops down, and short covering as we enter New York, pushing the price up. Ultimately, Alex, I expect this to greatly enhance real price discovery. So it hits the European banks at the end of this month. It hits the UK and the United States at the end of the year, the end of January, or excuse me, the end of December into January. So I think that, there's a very high probability, to answer your question succinctly, that we will see prices into the third and fourth quarter markedly higher than they are right now, because what in essence that you are doing is that you are taking the ability of the banks to push the price around with their unallocated precious metals, and you're really changing that completely and totally to an environment where you're going to have an awful lot of ammunition behind these types of trades, and I just don't think it makes sense. So I would argue the best is yet to come in many respects, because if we draw a linear line from everything I just said, a linear pattern, we go back and we see the banks repatriating their money or their gold, the biggest banks in the world. We see them accumulating the crap out of it for 2 years before they reclassified as the world's only tier one. Then we see the wealthiest, most influential private traders in the world over the last 2 years start pulling metal off the exchange, and that's accelerating. We see the IMF, the 190 countries from around the world say, give us back a new standard. We don't want the Bretton Woods standard anymore. We want a new standard. So you're seeing the biggest money in the world move away from dollars, and then you see the Chinese and the Indians really ramp up their gold acquisition since March, and the Chinese government giving the go-ahead to the big Chinese banks to start importing gold as well. This is the new development. So you're seeing massive acquisition by the biggest money in the world. And one other point I would like to bring up when we talk about where I think gold and silver are going, and this is something that isn't talked about enough, in my opinion, it is the Chinese Belt Road and Rail Initiative. It's the largest infrastructure project in human history, Alex. It's underway. It's China's attempt to connect Asia and Africa, not just by railroads and bridges and maritime channels, but digitally as well. So when we talk about the need for silver in that massive of an infrastructure project, it's enormous, but even more so than that. The Chinese are going to great lengths to distance themselves from the dollar. 2 years ago, they set up the system that mirrors the U.S. SWIFT system. They did that with all the BRICS countries, Brazil and Russia, India, South Africa. A system that allows them to escape the tool of sanctions by the U.S. government, which is the SWIFT system. They also set up the Shanghai Gold Exchange, which over the last couple of years has delivered over 90 times more gold than the price setting mechanism, COMEX. And the reason I think it's delivered so much gold is because they also found a way to work around the US petrodollar for settlement and energy. It's called the Chinese Petro-Yuan Bond. They buy oil from places like Iran and natural gas from places like Russia, and they pay for it in a bond denominated in yuan, which is immediately convertible into gold on the Shanghai Gold Exchange. So you see the biggest money in the world accumulating metals. You see the biggest money in the world de-dollarizing, buying precious metals. You see the International Monetary Fund saying we want a new system. You see the IMF reclassifying gold as tier one. You see the new reserve requirements, meaning that the fractional reserve, London Metals Exchange, and ultimately the US market and the TOCOM, all the big exchanges for precious metals, having to really change the way they do things in an unallocated, rehypothecated, and that means many people own the same asset, although they don't know it that way. The same asset is sold over and over and over again to the tune of 100 to 1 on the London Metals Exchange, and many people say 300 or 400 to 1 on COMEX. That's all coming to a head. And so I expect prices to be markedly higher, not only by the movements of the biggest, most sophisticated, well-funded traders in the world, but now the rules that Basel III is ushering in that will greatly neuter and mitigate the ability of the big banks to push the price around without having a tremendous amount of skin in the game when they never had to do that before. Ultimately, Alex, prices go much higher, but you got to have strong fingertips because there will be volatility. It will not be that easy. The big banks still have to get out of these positions, and they do that by shorting the price counterintuitively so that they can cover their shorts and ultimately be long or just out of the game altogether. So yeah, I think prices go way, way higher.
Yeah, you touch on some really important points with everything you said. And it seems like the system's breaking down. We're seeing like a repeat of history, basically. You were talking about how countries want to take possession of their gold again. And that's what happened to put in the Bretton Woods system. I think it was France that wanted their gold back, and that put in the new system. So you were talking about they want to make a new system. What do you think this new system would be like if this happens?
Well, ultimately, I look to gold's reclassification as tier 1 and believe that the only way, whether it's a new digital currency or not, that you ultimately gain credibility in a world that has been screwed by the dollar standard, by the evisceration of the value of the dollar through inflation and money creation, which, by the way, this year is 75% higher than last year. In other words, a 75% year-over-year increase in money creation is off the charts. It's normally 3 or 4%. So they're printing their way through this mess, and that will have ramifications. But if I had to guess, it will be a digital currency that has gold pegging to it. And if I had to guess, it emanates originally or first and foremost in China, where I think if the Chinese realize the dollar is doomed and that it's circling down in an inflationary drain, they will come out and say, yes, we've been accumulating more than 10 tons of gold a month for years. We're the largest producers. We're the largest accumulators. We have well north of 20 tons of gold, and which would be 3 or 4 times what the U.S. purports to have. Bear in mind, Fort Knox hasn't been audited since the 50s, so no one really knows what we have. But we're supposed to have like over 8,000 metric tons of it. And I think China, if they really want to be the world reserve currency or challenge the dollar for singular status, they'll peg gold to it. They won't make it convertible. You won't be able to walk into the People's Bank of China and trade in a new digital yuan for a gold panda. But I do think it will be backing it, and the validation of that gold will be on a distributed ledger. And ultimately, I think if the U.S. dollar wants to have any semblance of strength and of acceptance and desire to accumulate it and hold it as world reserve, they'll have to do something like that too, because really what they've done is more or less water down the value of the dollar so much at times when interest rates are as low as they've ever been. So you have super low interest rates. You have treasuries issued by an insolvent government who's inflating away the dollar. And this transitory inflation they talk about, whatever the heck that means, by their own admission right now is 4%. So you have 4% inflation, but yet if you ask John Williams of Shadow Stats or the Chapwood Index, they would both say north of 10%. So let's just take the government's own 4% declaration of inflation right now, transitory as it may be, with 10-year treasuries earning less than 2%, and inflation, really, and money creation off the charts. Who in their right mind would buy a bond guaranteed to lose you a minimum of 2% per year? No one is the answer but the Fed. So, I think that this is a very precarious position. It's a very precarious time, and gold and silver have never been more important to own because the fundamentals behind the U.S. dollar, behind the markets, are really, in my opinion, very, very, very tenuous at best. So I think you're going to see strong times ahead. And I think that what's happening to the U.S. dollar by its money creation ultimately is going to lead to a new system. And I think the dollar, whether it rises to a new standard to put people's concerns at ease by having some sort of a peg to it, or it comes from the Chinese, I think one of the two will do it, because I just can't see how you would ever be able to issue, even if it's a digital currency, it's still fiat unless it's backed by something. And I think what's happened with all of the world central banks printing their way out of the COVID mess and literally eviscerating the value of their currency is going to have some long lasting effects. And if anyone wants to stick out, they put a gold peg to it. And now you're talking about a currency that has value where it can't be inflated away by the whims of the politicians. So what do I think it'll look like? I think it'll be a digital currency with some sort of a pegging to gold. And maybe that's why they reclassified it after 80 years of it being tier 3 as the world's only other tier 1 reserve asset.
Yeah, the people seem to definitely want to have real hard money again, gold and silver. They don't want the fake money. And I think that's really one reason why, gold and silver has stood the test of time, because, the politicians couldn't make it worthless. So one thing that I have been seeing in China is that they've been making a new digital currency, a yuan. So I haven't really heard anybody talk about this. So I wanted to ask you, do you know of any information on how gold and silver are being integrated and currently exchanged as part of the Chinese social credit system?
I don't at this point. I know that they are big accumulators of it. They've just given the banks the go ahead to import it. They prod and push their citizens into accumulating it. The Chinese look at gold as wealth, not an investment. And so, they've been accumulating it for thousands of years based upon the fact that it's wealth to them. I don't know how it will work. And it really doesn't matter, because at this point, there's a dual system. There is the Chinese yuan or the renminbi, and there's also the new digital yuan. This digital yuan is what is being used to fund the new Belt and Road and Rail Initiative in Asia. So you have 70% of the world's population now being indoctrinated into a currency that I believe will challenge the dollar for singular world reserve status. But how does it value? The same way it would with the paper currency, with the dollar or with the regular yuan or renminbi. Whatever that value is, that's what it's valued at. There's not a discount or a premium to the digital yuan, but there are incentives issued by China for all the contracts that are settling in Africa to be written in the digital yuan. And ultimately, I think digital currencies will take their foothold. Government issued digital currencies will take their foothold. Not only does it eliminate many things like money laundering and black markets, because what do you get paid in? But it also will be able to allow the Federal Reserve to enact monetary policy directly into the public, because as it is right now, money creation only happens when the banks lend it into existence. Yes, the Federal Reserve creates money with a keystroke, and yes, they buy treasuries and Fannie and Freddie bonds from the commercial banks. But when the commercial banks sell those bonds to the Fed, as they are obliged to by law, that initially drives down the price of the level of interest rates and stabilizes the bond market, helps create the wealth effect, if you will. But that money does not get out into the system, and actually it's sitting in a reserve account at the Fed. Now, the only way the banks can access it, either they leave it there with safety, earning next to nothing, or they will lend it out into the economy through car loans and home improvement loans and mortgages. And anytime you get a loan, that's money that's been freshly created. So the banks have two options: keep it at the Fed with safety, or lend it into the economy to people who need it. But the problem is the lending standards have gotten so tight that they don't want to lend. And there have been so many foreclosures and bankruptcies and delayed payments, and the balance sheets of the banks in that respect are not that good. And so you'll find banks are rather reluctant to lend these days. But, in any case, these are very interesting times, Alex, and I think they're only just beginning. And I think the question people need to ask themselves is not how much gold and silver should I buy, but what exposure do you want to a currency that's 140 million in debt by their own admission, where a trillion seconds ago was 31,688 years ago, with interest rates at their lowest level in human history, with markets that are at all-time highs and most of them unjustified. These are crazy, interesting times, and I expect to see more of that over the next year or two, as I really think we're running out of options as how to remedy this. I think Mother Nature will have her way with the markets before this is all said and done, and especially if the Fed backs away from all of their stimulus. It's the stimulus that has helped keep the wheels rolling. If the Fed backs away from the stimulus, I think very quickly you'll see everything start to deflate. And I'm looking for corrections in the marketplace. You saw what happened to Bitcoin, 40% like that. These markets are struggling to find real price discovery. When you talk about the lowest interest rates in human history, coupled with massive money creation across the globe, price discovery is very difficult, as is price inflation beginning to rear its head. So real quick, when we talk lending money into existence, that's how money is created in the US. When the banks just buy those bonds, the only way that money is then transferred is if the banks decide to lend it instead of leaving it at the Fed. And so the only act that the Fed is really accomplishing by creating money and buying the bonds is lowering the back end of the bond market, lowering interest rates, which creates the wealth effect, and stabilizing a shaky bond market that no one wants to buy. You could make the argument that the Fed is monetizing the US government debt right now. They're not allowed to go directly to the Fed, but the banks are selling them to them by proxy. And I would argue they're one of the only entities out there foolish enough to buy treasuries that are yielding negative interest rates, yielding a negative return in a currency that's being inflated away. Not a good investment strategy unless you're trying to keep the ball up in the air. So I think before it's all said and done, all roads lead to the same place, and that is much, much higher interest rates and ultimately inflation. Because, if the Fed decides to back away from the bond market and stop buying it, interest rates spike and you're in the greatest depression of all time. Or if they decide to continue to monetize it because no one else wants it, now you're talking more and more money creation, monetizing the debt directly from the Fed, which leads to hyperinflation and ultimately higher interest rates. So we're in the sweet spot right now with low interest rates and prices in gold and silver that I don't think are accurately reflective in any capacity to the amount of demand, whether you believe what the US Mint says, a global silver shortage, or what a guy like me says as one of the bigger dealers in the United States, who's saying to you, we did a year's worth of business, over a year's worth in the first quarter alone. The market is on fire and the price is not reflective of that demand.
Yeah, and I think it's really interesting. We're seeing huge inflation already. I found this picture. I wanted to show it to you and get your take on it. So basically, here's the picture. So we see that the federal minimum wage in 1964 under the silver standard was 5 silver quarters per hour, and that was worth about $25 in today's money. So now the federal minimum wage is $7.25 per hour. So why do you think the federal government is decreasing wages?
I don't think they're decreasing wages. In fact, they're trying to increase wages. It's that the dollar has decreased in value so precipitously. And what you see right there is the truth in that if you have 5 quarters with a melt value, if that's what it used to be, that's what happens when you pull the real money out of the currency. I mean, when we talk about quarters and dimes and bills, that's currency. When you look at those quarters right there, that's silver, that's wealth, that's money. And gold and silver are money. The currency that we spend is not money. It's currency. It's a medium of exchange. But that's what's happened since 1964. That money has lost roughly 20 times its value just by pulling the silver out right now. So, that's exactly what you're talking about. Exactly.
Yep, and I think that shows that people need to get silver so they don't lose all their money in the long term. So yeah, and it was I really thank you for being on the show, Andy, and I hope everyone can go and check out his website, milesfranklin.com. And thank you for everyone who's watching this video. And thanks for answering all my questions, Andy.
Let me leave you with one other thought. Couple of things, Alex. Number one, if any of your listeners want to send an email to Andy at Miles Franklin and mention the Free American Press, we will make sure that they get the best price in the country. Our website is being retooled and rebuilt. Our online store is closed. We will have a new website up, I'm hoping, in 60 days, which will have some online features to be able to purchase. Our business, Alex, we've been around, just for your listeners' edification, for 31 years. We've never had a customer complaint and $6 billion in sales. We're one of only 27 U.S. Mint authorized resellers on the planet. And the state of Minnesota, where my corporate office is located, is the only state in America where you have to be licensed and bonded. And that's a big deal in a federally non-regulated industry. So your listeners who are looking to get exposure to metal, can rest assured it's the safest transaction in the industry with us. And we'll make sure they get the best price to boot, mention your name, and I'll make darn sure of that. And we'll also throw in a portion of all of those sales to you and your endeavors to help continue for you to help continue to get the word out there, which is so important. You know, the media isn't telling us anything. The media didn't tell us anything about Basel III. The media hasn't told us anything about the IMF asking for a new Bretton Woods. Media isn't telling us anything about what's really happening with the economy, with precious metals. The media will lead us with the rest of the sheep to slaughter when the dollar runs into big trouble. And look, it took this country almost 300 years to create 800 billion in wealth. We've created 7 trillion in wealth or in money in the last year. The dollar's days, I believe, as the singular world reserve currency are coming to an end. And the question is not how much gold and silver should I own, but what exposure do you want to a currency system that is behaving this way when the wealthiest, most influential people in the world for the last 4 years have been quietly exiting stage left? That's what you need to ask yourself. So I appreciate being here with you, Alex, and I look forward to doing this weekly with you moving forward. I'm proud to be associated with you, and you're a fine young man, and I think more people your age need to listen to you, because you're providing a real education for free. A college level education for free, with all of the people you have on your show who are trying to show the public that, hey, things aren't all as rosy as the mainstream would have us believe. And I think the big money who understands this by their actions, you can see they believe that to be the case. They're quietly exiting stage left before it becomes obvious to the rest of us that we're in big trouble. And so for what it's worth, it's great to be here. I look forward to coming back next week, hopefully the same time, Friday, and look forward to picking up with you then.
Well, that sounds great, Andy. And please check out his site, everyone. We need to go back to sound money. We need to stop using fake paper dollars. And thank you all for watching. God bless.